trade review from some movers from last week, specifically Thursday and Friday, just to try to get my brain on track and back in the flow of the market somewhat. So on Thursday we had not a lot of follow through. There was minimal volume. As we can see, this is one of the leading gappers, not really kind of holding throughout the morning. So by 7:15, the majority of the market volume had gone away, and it was an early week. Friday was off, so it was one of those days to not really expect much volume. Nonetheless, if an opportunity presents itself, we're going to take it. So what we can see is a gap up early morning. Technically, buying gaps below where it gapped is not necessarily a good spot to buy into. However, it did come down below the gap, and since it had gapped prior on such great volume, we could expect even a minimal bounce, especially when it had put in these or this wedge. Basically, this is basically a wedge break play here. So let's just get rid of all these. Actually, it's not horrible. These are the lines that I drew from that day. We can really just go from the beginning. First thing I'm looking at and seeing, especially with this wedge break, is the fact that it tried to come back up and couldn't break. That's probably specifically because it didn't close this gap to the downside before moving back up. So it's not going to really try to get to support until these levels. And at that point, you're already coming down to VWAP, and then you've got this previous high. Since it gapped, you can definitely see some volume coming back into the market below this gap because it's a top player. So either way, how does our strategy work? First, we see this gap up, right? This happens. Strong relative volume comes up, and we can move to the yearly as soon as we see that, and see that this stock has only been trading for however many days. So we can go to the 5-day, 5-minute and try to draw out some lines here. Looks like it really only gapped up in pre-market, so this definitely had the potential to become a huge mover. However, it was a very low volatility market, and this is just, that's how it is. The market conditions didn't agree. So let's see here. All the way to 7.4, so maybe just draw out some lines here. Not really much to draw out on, so we'll just zoom in. And initially, especially with this kind of play on a low volume play, if we're buying the dip on this one, our price target really only needs to be up at 722, especially if we're getting in at sixes. A whole dollar on a slow day like this would be profitable enough. So what do? It comes up, we zoom out, look left, of course, first, and we look for a previous high that I put in that it broke out of. That's the first thing. We want to see this thing come up and be in an uptrend at least. If it intersects with VWAP, that's great, but really we're not interested in this until it gets down to this range, right? This range right here. Right through here. And as we can see here, it's a strong mover, so a lot of the times it's not going to perfectly come down to this line. So maybe you have a bid at that level, maybe at 591 or something, because usually the 10-cent mark is where it comes down to. But it didn't reach that level, so it got to 594, quickly bought up, which is what you want to see. Consolidated, hammer candle, could have bought in around 6s to 6-1s, right? And at this point, you've already got a trend line in from pre-market that's not going to be that strong, but obviously it came down wedged, found support, and now if it found support in this level, maybe if you're like, all right, well, if this doesn't break out, maybe if I can get in before it breaks out, so you buy it maybe 601 or something. And so now you're in this trade and you want to see it break this wedge. So it breaks this wedge, and usually right after it breaks the wedge, there's another dip buy opportunity. If you are if you're very unsure about the market, it's really the best time to buy this is actually once it breaks the wedge break, that's when you know it's probably going to keep moving, and then you buy the first dip, and then that's your final entry before it moves up to price targets, which was actually for 6.7, where this previously tried to break out at. That would be my first price target, and then this my second, but it didn't have enough strength to get through there. Either way, it dipped below VWAP, and that's another reminder that really a naked chart is going to be has a priority above all EMAs, VWAPs, everything. But the VWAP is just there to because everyone else uses it and is a great spot um, to kind of confirm some moves. But a naked chart is very helpful as well. So pops up, get a nice dip buy, and if you're buying in here at like 610s or so, now since you're in this, your stop loss is the low of this candle, which is 593, and you want to have a tighter spread on a day like this, so I had mine at 599 because the full dollar amount, and it never dips below 602, comes right back up, forms a hammer candle above the VWAP. So that was just my little taste. I was like, okay, that's a nice look. Comes up to first price target. I have my sell right at this level, 669, and I trim half my position there, and then it kind of falls back through, kind of reconsolidates, and this is where you want it to hold this level. And now your stop's moved up to 643. You've trimmed half your position, and then the stock simply fails and drops back below and comes off VWAP and then falls even further. But VWAP didn't really matter prior, so it wouldn't be a smart move to buy the dip off of VWAP at this point because it wasn't a part of the original move. Always look left, and whatever the market gave you is whatever data it gave you prior is all the information that you can really pull from the market, and you have to create an inference based on previous data to really help you understand what the market's going to do next. Not really what the market's going to do next, but how to create the best probability that's going to move in whatever direction you want to go. So came up to this price target, and obviously this is kind of just a range, got pushed down through there, right? These weakness candles got pushed down right there. Dip was bought. People were still kind of bullish on it. And then they tried to get through that level again. And you see these longer wicks up here showing weakness. However, they're not horribly weak. You're still going to be in this for some shares, but your stop has moved now. And your stop is going to be at 643 conservatively, or possibly down to 627s because you don't really want to see it. You really just want to see it put in a higher low. It could have even been down here, but at this point with such a weak market and the market coming down, might get stopped out at 643 because this in this market is with this type of move, it had already gapped up, and on that gap it came down pretty far. So you're not thinking of a big move up, just kind of a reversal. And then this is what I would call a death candle. This is more of a death candle, but a higher volume sell-off candle is definitely going to continue that trend in that direction, and boom, it faded the rest of the day. So that was UPC, all I could really see from UPC, and that's an example of it's still a winner, but the other thing that you have to be really comfortable with is that this stock at the same time, you could have bought in this dip, and then it could have broken down from 592 and continued lower, and at that point you just have to get stopped out and say, well, there's nothing wrong with my strategy, the stock simply failed me, and that's all it takes. And having a sound plan, your price target, your stop in place, and really just monitoring level 2 once it gets to your price target. You don't really need to monitor it the whole way up. You really just want to see not as many sellers through here and more bidders maybe, but mainly you just want to be watching level 2 as it creeps up towards your price target where it got denied pretty hard last time. If it would have gone up in here, I would have been like, okay, above 7s, I'm going to watch this closely to see if there's any huge sellers that I don't think the volume could try to break through, and we could see if it tries to break through, but a lot of the times if it gets back up there and it's like a 80,000 share seller or something, it scares off some buyers. So either way, you get stopped out for a pretty good win there. If you get in at 610s, you've probably made about 60 cents on the dollar for half your shares, and then 40s. So probably around 650s is 40 cents probably about on your shares. So not bad, but really just a slower market day. But it really does show the profitability of this strategy because of how really how lucrative it is. You can use it in slower days. You know, I understand this gapped up, but it really faded quickly, and you were still able to get out 40 cents on it and walk home with a nice, I don't know, 7-10% win. So that was UPC. Now let's go to YVR. This is a more of a volatile play here. I don't know if this thing was this from. This had to have been from. Yes, this is from. Was that Wednesday? Yeah, Wednesday. Okay. So this was a nice play for multiple reasons. Obviously, we see this same kind of pattern. Yeah, this one was a little bit more, as you can tell, a little more volatile. It's got a nice wiki candles all through here, but same kind of pattern, right? You get the pop through the previous high, right? Pop through the previous high. You get a fade back down to these levels. It finds support, so you want to see before you ever enter. This is just more confirmation for you. Finds support, tries to pop back up, comes back down again, creates this larger wedge through here, and then finally finds support at where this popped up before in the morning, and pops up through. And at this point, it's below VWAP, so I'm not going to be adding this dip. Wait for that pop through, and then of course, look, we get our first dip. This is a very lucrative pattern, you know. So we get our dip, comes back down, fades down, blah blah. And if you're going to be buying this one, your target is 519. Your entry is off of this lower trend line, which you have nicely drawn from pre-market and also previous support. So that's a very nice entry right there, around 445s. And your price target is going to be 519 because that's not a huge drastic difference. And if you're trying to trim some off originally, this is also a very weak reversal on this kind of a trade, but it did get volume back into it right through here, which is what you want to see, especially when it breaks that wedge. You want to see this volume that it had earlier come back in at some point, but it still was a little bit lower. Either way, you get that dip buy. Maybe you try to trim some at 487s, but we see a nice consolidation right here. You don't want to really see a break VWAP, so now your risk is a profit, which is great. So you let it reconsolidate through here and just kind of see what it's going to do. Maybe let your stop sit here, see what it does more towards this 487 because of how hard it got denied back here on this previous one. And so it pops up through there, gets to fives, gets the 5 test and gets denied. So once it drops back down to 486, you're probably going to be out because that's just going to keep going down for the rest of the day. But yeah, this is a good trade. A, B, C entry, D breakout. In a strong market, this could have gone to 6s. Either way, this was a good trade. You know, it's very, very lucrative and good to trade. You notice at any pivot point right here, it gets really good volume. Right through here where it broke that wedge, and then on the dip buy, gets volume right after where you're buying. And you see hammer candles come in, which is great. So, boom, pops up. Nice little section there. I also saw actually saw one through here before this had all been drawn out. I was more focused on this. It had found support through here, so I had bought in this dip at first, and the price target was 482. First price target. I actually trimmed more than half through here, and then it got denied really hard, so and got out for a small profit there, and then saw this this trend kind of continue. but then ended early. So Wednesday and Thursday were pretty slow. Still could have pulled out 5 to 10% both days. So that's just on those 2 days, which are really slow. It's a 20% day. So I know there's not many people watching these videos, but this is my strategy and this is how I do it. And over time, you kind of just see these things second nature as they're happening. If you eliminate this side of the graph, it's really easy to see these things after, but are you able to see these things before? So you just really got to draw out those lines and look left and understand what kind of position this stock needs to take, what kind of data the market needs to provide for you to enter. And I repeat this all the time, but you got to visualize these things in your head and be like, okay, I want to visualize myself actually sitting there and taking the trade, but not only visualize the upside and you hitting that goal of 519 or above, but you also really want to see you buying the dip at a good spot and then the thing tanking and hitting your stop, or tanking and then you have to get out quickly, because if you're winning on 50% of your trades, guess what? 50% of the time, even if you're in the best stocks, right? You're not taking random trades. You need to be taking the best trades, and you're only winning 50% of the time. Guess what? You have to control your risk, but you have to allow your upside to continue on. But the psychological part of it is that if it does fail, and it will for 50% of the time, you have to stay just as calm as you do when the stock goes in your direction. You have to not be emotionally separated from the analytical standpoint. You have to really accept the fact that 50% of the time the stock will come down here and then fall off. And you have to just suck it up. Be like, okay, well, that sucks. That was a nice setup. I had a nice plan for it. Moving on, right? You gotta tell yourself to move on, and really that will change your game. That will change your game. That will really, if you can accept losses, if you can accept losing, if you can accept losing money, if you can accept the fact that you're going to win money, and tell yourself that this little 2% loss that I have at my stop isn't going to drag me down, because I know that there are opportunities every day, and if the market's going against me all day, I'll come back tomorrow and see what's going on. But even on a big losing day where you lose 6% and say that's way down the line, when you've got $50,000 in your account or whatever, or you've got $100,000 in your account, you're down 10 grand on the day. You gotta stand up and really walk out of the office or your whatever room you're in, or wherever you are, with a smile on your face, and continue your day just as you would if you fell flat or if you had made $10,000. Because an attitude that changes with the market is a losing attitude. Because say you take a trade and you take a loss, and now the next trade you go for, you're like, oh, I took a loss. The market doesn't care about that. The market's not going to say, hey, it's okay, I'll give you an easy trade. That's not how it works. The market is technical, so you must go with the flow and be with it technically, if that makes sense. So I think this last portion of it, I actually just dumped out a lot of good information, and I'll definitely be looking back on this if I ever struggle. So good luck to all traders that have really stuck through it. Been here for a year plus, 2 years, 3 years, and are still looking to motivate and educate themselves to reach that next goal, whatever it may be. If it's losing less money, breaking even, or finally finding consistency, all educational information is helpful.